Hey folks, what we now want to do is take a look at the transactions that the corporation has with the shareholder / dividends as a general rule. But remember, we have to look at current earnings and profits. We have to look at accumulated earnings and profits. And if there's neither, then of course it's a return of capital and lowers your stock basis. If you've gotten all of your basis back and they still give you money without any earnings and profit, then it's called a capital gain distribution. Let's go over some of those tricky little rules so that you're well prepared for any questions they ask on your exam. A corporation's dividends are generally taxable as a dividend to the extent of earnings and profits. Think of the term retained earnings. E&P is tracked like retained earnings, with both accumulated balances, all the prior years, and the current balance, earnings during the year, being calculated. Once dividends exceed E&P, taxability takes on a different consequence. Let's illustrate this. Think about storage containers of ingredients used for cooking. We have a canister with current E&P, a canister with accumulated E&P, and a canister that has your stock basis. Now let's chat a little bit about a recipe for success on the CPA exam. First, use the amount of current earnings and profit. Any dividends paid out of current E&P are taxable as dividends to the shareholder. Second, use the amount of accumulated E&P. Any dividend paid out of accumulated E&P are taxable as dividend. Next, if you run out of current and accumulated E&P, look to the remaining stock basis. That's called a return of capital and is tax-free. If you've used up all the current E&P, all the accumulated E&P, and you've used up all of your stock basis, then any distribution is regarded as a capital gain distribution and taxed as such. Let's apply this. In application of what we've just learned, suppose a company has current E&P of $20,000 and accumulated of $130,000. That's, by the way, a grand total of $150,000, isn't it? The company distributes a cash dividend of $210,000 to shareholder A. And by the way, shareholder A's basis is 60. Well, in this case, we know that 20 comes out of current E&P, 130 is coming out of accumulated, that total of 150. So of the entire 210, 150 is going to come out of earnings and profit. But we gave 210. That means the extra 60 that was given is going to be a reduction of the tax basis. Therefore, it's tax-free, but now your stock basis will be zero. You got your money back. If they had given away even more money, then any excess above and beyond that would have been a capital gain distribution, taxed as such to the shareholder who received it. Hopefully that gives you a nice indication and a visual of how we do this. Now you're ready to try a full-blown exercise.